Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, November 23rd, 2020, and I'm pre-recording this Trading Places Live for Tuesday, November 24th. Futures currently are solidly higher as the Dow Jones sets its sights once again on 30,000. It did finish less than 500 points below that level on Monday. It was a strong day. We're going to get into that in just a minute. The agenda for today, we'll talk about that daily market recap, go into talking technically, going to look at the S&P 500 a little bit and compare that to the relative strength of some of the defensive sectors. I think you'll find that interesting. Then we'll get into chart breakouts, but I'm limiting this to chart breakouts with scooters less than 80. So these are companies maybe that haven't been leading for a long period of time, but instead maybe you're just making breakouts. So we'll see what that reveals. Then we'll get into the earnings spotlight and the three you must see, and we'll wrap up the show. Before I get into any of that, I do want to take everyone to earningsbeats.com. There's a area on our website. If you go to earningsbeats.com, you'll see our free Earnings Beats Digest newsletter, where we have our name, a space for you to put in your name, email address, hit that subscribe button. This is an newsletter that comes out Mondays, Wednesdays, and Fridays, usually before the market opens. Try to feature earnings, relative strength, some of the things that we talk about a lot at Earnings Beats, some of the strategies that we use. But it is a free newsletter. There's no credit card required. You can unsubscribe at any time. But we'd love to have you join our community. So if you haven't already done that, check that out. Type in your name, email address there, and you can become a Earnings Beats Digest subscriber. We also offer our regular membership on the same page there. You'll see that green button, Join Today. We have a $7 fully refundable 30-day trial. So if you do sign up, it does require a credit card. You will have to pay $7, but we'll refund you the $7 within 5 to 10 business days. So essentially, you get a 30-day free trial. And if you look at our performance, performance has been just literally off the charts. Model portfolio, this was as of Friday, where we were up 171%. That actually grows to 177% after Monday's close. We had another very strong day in our model portfolio. In fact, since our model portfolio was announced on Thursday after the close, so we're talking 2 trading days, model portfolio is already up 4% this quarter. The current quarter for the S&P 500, this is through Friday, the minus 0.68, but right now it's minus 0.12%. And yet model portfolio already up more than 4 percentage points. So we got a nice start to the quarter. If you'd like to find out what stocks we have in each of our portfolios, if you sign up here, you can go in, you can check out our portfolios and see the stocks. We put 10 equal weighted stocks in each of the 4 portfolios, and we do this every 90 days. So after 90 days is over, we've replaced them, look at the current market, take a look at what's leading in terms of sectors, industry groups, and we try to fill out a fairly diversified portfolio. When I say fairly diversified, we're not going to put stocks in these portfolios if they're part of areas of the market that are underperforming. We stick with leading areas of the market, and we look for leading stocks within those areas. All right, let's move on. Take a look at the daily market recap for Monday. The Dow Jones Industrial Average was up 328 points. The S&P 500 up 20. NASDAQ up 26. Mid-caps up 34 points, 1.6%. And best of all were the small caps. The S&P 600 small cap index up 23 points, which was about 2.25%. You can see moving to a new high, that AD line breaking out to a new high, the PPO looking strong. I really love what's going on in the market right now. I have said many times in the past, I'll repeat it again, we want to see wide participation. We don't want a narrow band of stocks leading the market. We want everything participating. And now that we've got mid caps and small caps joining the party, I find this to be extremely bullish for the market as we move into the latter stages of the fourth quarter of 2020, and of course, head toward 2021. Energy stocks on fire on Monday, up another 7%, $2.50, 38.34. Be nice to get up there and take out that June high, which was up in the 40s. I don't know. We still got a little bit of room to the upside to get there, but still, energy having a very strong month of November so far. Financials also up strongly, up almost 2% on Monday, and in breakout territory with that vaccine news from 2 weeks ago, Pfizer 2 weeks ago, and then Moderna last Monday. Today, we had another one out. This was AstraZeneca. So now 3 Mondays in a row, we've had 3 vaccine announcements. Also today, Regeneron had an announcement. The FDA approved its COVID-19 antibody cocktail for emergency use authorization, gave it emergency use authorization. So that was at least an initial boost for Regeneron before it pulled back later in the day. But overall, the announcements keep coming in. We're getting some really good news in terms of vaccine data. And I think that's allowing the market to look beyond COVID-19. And some of the rotation is pointing to that as well. Industrials, another great day, up about 1 2/3%. We continue to break out. This is a group that's been leading for several weeks, really all the way back to about May. That's when we had a relative bottom on industrials. So we've been on a relative basis outperforming since then, but things have really accelerated here in November as the market again looks beyond COVID-19. Renewable energy, very, very strong on Monday, another 8% to the upside, breaking out once again. This is a group that has been trading above its 20-day moving average almost exclusively for the last 6 months. We did have that dip in September, but otherwise, we have been trading mostly above that rising 20-day moving average. Very bullish action there. Not so bullish in the gold area. Gold miners, miners in general, just not performing well. You can see the DJUS PM here, the gold mining index down to its lowest level since back all the way into June. This is a group I have been telling Earnings Beats members personally I would avoid. I just don't like the group. It's not that I don't think gold stocks could go higher. I just don't think they're going to outperform the S&P 500. And that's really what it's all about. We want to seek outperformance. And I don't think we're going to get it from the gold miners or the miners in general. All right. 10-year Treasury yield rose about 3 basis points on Monday. So we were able to finish up at 0.86%. We had been downtrending for a while, went back and filled the gap from back on November 6th. But we did have a nice little rally today in the yield, which means money is rotating out of treasuries. That typically is good for equities, and it certainly was on Monday as we saw the equity markets have a very strong day across the board. All right, let's move on to talking technically. I want to bring up the S&P 500. And if you look back to the end of October, first of all, back at the end of October, I was talking about the latter few days of October and the first week of November being one of the most bullish periods of the year, actually the most bullish period of the year. And we saw exactly what happened here in the early part of November. Big move up, really performing just as we would expect based on a historical basis. Since then, however, you can see we've been going sideways. So we had that nice move up, got the vaccine news from Pfizer, and since then, we've just been going sideways, and that's not a bad thing. I think the S&P 500 is catching its breath. We're seeing a little bit of profit taking, but as we see profit taking, and more so that profit taking is taking place in areas like technology, but that's not taking the market down. Instead, the money coming out of areas like technology are finding a new home, namely industrials, energy, financials, to some extent, consumer discretionary. But this sideways action is not bearish at all. Off of an uptrend, I expect after sideways consolidation, we'll get a breakout to the upside. That's what I would be looking for. So the S&P 500 looks pretty good here. Now, what I wanted to show you on this chart is how the defensive groups are acting on a relative strength basis. Now, I want you to keep in mind, one of the things I look for is when the market is breaking out, I want to see relative strength in the aggressive areas, like the industrials, like financials, technology, consumer discretionary, and communication services. Those are the 5 sectors that I like to see leadership from when we're breaking out. We want to break out in groups that are aggressive because it tells us that the market has an appetite for risk. And that's what drives bull markets higher. The flip side of that is we want to see defensive groups underperforming, not necessarily going down, but going down on a relative basis. On an absolute basis, they can go up. That's fine. We want them to go up, but we don't want them to lead the action to the upside. So as we take a look at the S&P 500 in November here, we got this big move up, sideways action. Here's healthcare. Healthcare got a little bit of a pop at the beginning of the month, but since then has been going down. Consumer staples so far in the month of November, for the most part, outside of maybe just this little bit of a recovery, it has been downtrending relative to the S&P 500. Utilities, downtrending relative to the S&P 500. Real estate had one pop on the open on the 9th, which was vaccine-related news. Other than that, it too has been moving lower on a relative basis. So as we're moving up, these defensive groups are doing exactly what I would expect them to do. They're lagging and they're allowing the more aggressive areas of the market to lead during a period of a breakout in the S&P 500. So all of this news and all of this action, in my opinion, very, very bullish for equities. I see the market continuing to go higher in 2020 to close out the year. And I think we're going to have a really good 2021. I believe we are going to be looking at the S&P 500 with a 4 handle. And I believe it's going to happen sooner than probably most would believe. All right, let's take a look at that gold mining group. So this is the DJUSPM, $ DJUSPM, and then the colon $SPX. That gets you gold mining index divided by the S&P 500. So this is a relative chart. Now, if you study history, one thing you'll realize is that gold tends to do better when 2 things happen. One of 2 things or both things. Number one, when the dollar is falling. When the dollar is falling, gold tends to, it actually performs on an inverse basis, if you will. So when the dollar goes up, gold tends to go down. When the dollar goes down, gold tends to go up. The other thing that tends to drive gold higher is fear. So when you see the volatility index shooting higher, that tends to coincide with gold also outperforming the S&P 500. Now here you can see on a relative basis, gold mining shares crushing the S&P 500. This was back in February through May when we had the tremendous fear in the market and the pandemic really gripping U.S. equities. Since then, though, in May, look at where we are on a relative basis. Now, I know there have been periods where gold has done really well on an absolute basis. And in fact, I'll come back to this chart, but if we get rid of the S&P 500 and just look at the chart, you'll see that in August, gold mining actually took out the May high. And when you look across here, you just see kind of sideways consolidation. But now let's go back and look at it relative to the S&P. And you'll see that that August absolute high did not translate into a relative high. Instead, the relative strength was actually heading lower. So if gold's going higher, or gold mining, gold stocks, if they're going higher, but they're not outperforming the S&P 500, then I'm not really sure what the real benefit is of owning them. I mean, gold, like I said, back in February, March, April, May, was leading. And so that was a great time to own gold because you were outperforming the S&P 500. You had a better chance of outperforming the S&P 500 if you owned gold. I think the opposite is true now, and the month of November has been brutal for gold relative to the S&P 500. The gold mining index was at a 0.044 back at the beginning of November. Now it's at 0.037 or just below that level. So we have been declining rapidly, and we are now at a relative level that we had not seen since back in March. So we're talking about a 8-month relative low. That is not the type of action that I would want to be a part of. So I am avoiding gold. I've suggested to members at Earnings Beats that they also avoid gold. I just think there are better investment alternatives and opportunities out there. So I would stay away from it. Now, I mentioned the volatility index, so I wanted to bring this up. And you can see, look at November, look at the volatility completely falling out of the market. And if we go back and we look at gold relative to the S&P, it has completely been crushed by the S&P during the month of November. And again, the fear is subsided. We're down now near the August low in terms of fear. And if we break below that level and start moving toward 20 or below 20, we're going to be looking at the lowest level we've seen since back at the start of the pandemic in February. So I think with volatility coming down, I also think that there are some signals suggesting that the dollar could rise. If the dollar rises and the fear comes down, you don't want to be in gold. That is a lose-lose. Those two signals tell us to stay away from gold. So pay attention to the charts, pay attention to the breakdown in the relative strength of gold. And personally, for me, I would stay away. All right, let's move on. I want to talk a little bit about these breakouts. All right, so there's a lot of different ways to look at breakouts, and I started with 52-week highs, but I wanted to filter it. I wanted to look at areas that were breaking out, but that had scooter scores under 80. Now, if you look at scooter scores, if you're familiar with that, it's the StockCharts technical rank. It's a formula. It was developed by John Murphy. I think it's a brilliant way to look at relative strength, but like any indicator, like anything in the market, there are limitations. And the biggest limitation with the scooter or the StockCharts technical rank is that it only takes into account the last 6 months worth of data. So energy stocks, some of the energy stocks are starting to see their scooters really jump, but energy's been horrible for 9 years. And we're just starting to see some really nice strength. You got to be careful because some of these scooter scores are going to jump, off the charts at you. Quickly, some of these energy stocks are going to move up in the 70s, 80s, maybe even 90s if some of the strength continues for a while. I don't know that that is a great signal for the long-term prospects of energy. I think energy was beaten down for so long that we're getting a really nice relief rally, similar to what we saw back in June. But I would be careful about reading too much into it. All right, so let's take a look at some of these breakouts. Again, these are breakouts with scooter scores below 80. So these are not necessarily going to be stocks that have been going up day after day, week after week, month after month. I'm hoping that some of these would actually be a little bit more sideways consolidation in a breakout. So ABBV is the first one here. And you can see back, we had the high in February around 93, 94. We had the high in July around 100. And we just broke out above 100. So we've been doing mostly sideways consolidating. ABBV, though, did make this breakout on Friday of last week, and it just continued here on Monday. Acacia Communications, look at this sideways consolidation. I love this breakout with the heavier volume coming in. I think this is a very strong breakout. This is a ETF that excludes the U.S., but looks at a lot of the global markets, and it's breaking out even without the U.S. involved. So this is a bullish sign to me that we're getting wide participation around the globe, and we want to see that. I believe this bull market is going to be one for the ages for the next several years, maybe a dozen years, into the 2030s perhaps. Doesn't mean we won't have pullbacks, doesn't mean we won't have cyclical bear markets like we did with the trade war at the end of 2018, like we did with the pandemic here in 2020. I don't expect to have one every year, but I wouldn't be surprised from time to time to see the market pull back 20% over a few months. I don't expect it now. I don't expect it anytime in the near term, but don't be shocked over the next several years if we don't have a few of those. APH, Amphenol, nice uptrend, continuing the trend that it's been in really for the last 8-9 months off of that March low. But it's been just a steady move to the upside. Looks pretty solid. ASML, this is in the semiconductor space. I like this sideways consolidation. The volume coming in early November to break out. I think this one looks good. Canadian Imperial Bank, CM. Don't see too many banks at 52-week highs, but CM is up there. Emerging Markets Bond ETF breaking out to new highs. Element Solutions also moving to a new high after sideways consolidation. Fitbit, lots of consolidation around $6.90 to $7.10 in that area, just broke out. FMC Corp just breaking out to new highs. First Trust Preferred Securities and Income ETF breaking out. AD line looks strong there. The core MSCI EAFE ETF also breaking out. Again, strong AD line. Then you've got the International Stock ETF breaking out. That's nice. Marinus Pharmaceuticals. Now here we got a false breakout. I'd be a little more cautious, I guess, in the near term with MRNS. Anytime on an intraday basis, I get a breakout like that above prior highs with a close on the low and a failure, I just think short-term pullback. But I would be surprised if this moves much lower than around 1375 or so. So I'd be looking for a little bit of a pullback, but I think that could create a nice opportunity there. Myers Industries making the breakout above prior highs, which were up around that 17 level. Nice breakout there, but the volume a little lighter than I would like to see. Nutrien, I like this stock. Very, very nice sideways consolidation. Look at the volume. Pretty solid as we've made this advance in November. So I think that one looks pretty good. Palo Alto, big volume coming in, gapping up beginning of last week, and it continues to set new highs. So Palo Alto looks good. Pacira Pharmaceuticals breaking out above the double top from August and September. Pulling back, I would watch the rising 20-day EMA. PTC making a breakout. AD line also breaking out. This is a stock that looks pretty strong. PTC Therapeutics, double top, up at around the 60 level. We've broken above that. Watch that rising 20-day. And we'll move on to the final list of stocks. Royal Bank of Canada breaking above that February high, closing above 80. Nice move there. Sealed Air, very strong action recently. Nice gap up a couple weeks ago, pulled back, hit that 20-day, bounced off of it. To me, that suggests we are trending higher. I think SEE goes higher. Spiro Therapeutics, nice breakout. A lot of sideways consolidation between $14, $15. Friday, we broke out, and then we moved up a little bit higher today. Steris STE, also breaking above that October high, pulling back. I think gap support and that 20-day, gap support's right around the 50-day. So I think anything in the mid to low 180s, if we were to get down there, I think would be pretty solid entry into Steris. Sunoco breaking out, looking pretty strong. Toro also with the gap up with the vaccine news back on November 9th, pulled back, held that rising 20-day, and we're now breaking out again. UBS, strong month of November, able to forge above the highs set back in February. Vanguard Total International Stock ETF, moving to new highs. I like that. Zoomies breaking out. Nice move up November 9th, pulled back, and now breaking out again, volume increasing, looks strong. And so those were the chart breakouts that I wanted to go over. Bunch of them, tried to go through them pretty quickly. Got a couple of earnings reports I'd like to talk about. Let's pull up first. AMBA, this is Ambarella. They beat top line, they beat bottom line, 9 cents versus 5 cents. Stock is up almost 9% after hours. So a really strong day. Looks like, or strong after hours. Looks like we're probably going to break out or come close. Watch 72.50. In fact, let me give you the number. I would be watching 72.57 tomorrow at the open. If we close above that, I think we're going to get a nice continuation move to the upside on Ambarella. If it opens below 72.57, goes up above it intraday and comes back down, I'd be a little bit more careful in the near term. Either way, though, I think eventually we go higher. Agilent. Another one that's got pretty good action here, but after hours, it is down. So the chart looks good. When we look at relative strength, I think it looks really solid. AD line is solid as well. It pulled back a little bit, starting to turn back up again. So I like the chart, but it is down 3.5% after hours. So I'm guessing we're going to test that 20-day again. I would be watching maybe 105 to the downside. That would be my line in the sand. I think if we close below the 50, we want to be a little careful here. One other stock that I'll mention is NTNX in terms of earnings. This is Nutanix. AD line very strong. Stock turning back to the upside. It is up almost 9% after hours. They blew away the revenue estimates. Market was looking for just under 300 million. Came in at 312.75 million. Bottom line, looking for a loss of 57 cents. We had a loss of 44 cents. So a little bit better than expected there. And like I said, stock up 9% after hours. So we are going to break out above that August, September high. All right, 3 stocks you must see. I'm going to start with Verisk and go through these pretty quick. AD line, awesome. Just recently broke out. I like this pullback to the 20-day moving average. CHTR, Charter Communications, AD line weak. We do have a triple top up here. Eventually, I want to get that breakout and get some volume coming in. Otherwise, look down to about the 50-day moving average for support. And the last one, FLT. This is Fleet Core Technologies. I like this 20-day test. Big move up with the vaccine news 2 weeks ago. After getting to 280, comes back down almost 10%, hits that 20-day moving average. I think we should bounce off of that. All right, that is it for me. Again, go over to earningsbeats.com. Make sure you sign up for our free newsletter, and love to have you join on, and check out our service. $7, fully refundable, 30-day trial. We'd love to have you come on board. Everybody, have a great day. Be back on Wednesday over at earningsbeats.com for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.